Good morning, everyone. So we are Group One, and we have a financial statement analysis of two London Stock Exchange company, which is food industry also, which is Grab PLC and Greencore Group PLC. So today our report will focus on comparing their financial and non-financial performance from 2022 to 2024. And our final aim is to recommend which company will be a better choice. So these are our group members, Hoyin, Jamie, and Kiet. Okay, next up. Okay, so basically, I will have a very brief introduction with the company background of Greggs and Greencore. So basically, Greggs is a very famous UK bakery and food on the go retailer. So uh, it sells directly to consumer through their apps, through shops, through retails, through franchise, through delivery service in the app. So the main product including sandwiches, bakery items, drinks, snacks, those food that you can grab and go. And then so Grabs they focus on affordability, convenience, and accessibility. Next, we'll focus on Greencore. So Greencore is another, excuse me, Greencore is a convenience food manufacturer. So instead of selling straight to the customer, they sell to business, to supermarkets, to supply food products to retail and food services. So their products also have sandwiches, salads, ready meals, soups, and sauce. So this shows that the two companies are in the same food industry, but they are selling different, but their business models are very different. So Grab is a B2C model and Greencore is a B2B model. Like I mentioned just now, sorry, Grabs is straight to the customer where they have delivery apps, they have Grab app, and they have Grabs, it's not Grab, sorry, Grab's app to straight away sell their products to the customer. But Greencore will sell their products to business, to food services, like those sauce right? Okay, they will franchise those products to others. So their customer volume will be very, but their target customer will be very different as well. Okay, so for their competitive advantages, right? Grab's main strength is strong value for money, food on the go model. The company is they able to offer affordable and convenient food while maintaining the quality. One important advantage is that Greg has its own manufacturing and logistics system. This helps the company to control the cost and then the product quality and the supply chain efficiency. So Greg also has a strong brand loyalty that can reach customers through different many channels like shops, franchise, delivery, the apps. And then for Greencore, it is a very large scale of production and they have a very strong partnership with supermarkets. So it has a very wide product range and strong food safety distribution system. These strengths allow Greencore to serve major retails efficiently and remain the important supplier in the UK food supplies market. So that's all for my very brief introduction part. I will pass my part to Yopian, right? Okay.
Okay, so next. Okay, so I will be explain about the pastel of the breeds and also the Greencore. So the first political, which is the breed, the both company have facing the same problem, which is strict food regulations. And for the Brits, will be more affected by the UK business rate and also the energy policies. And for the Greencore, they have might a bit different, which is affected by the British regulations, trade barriers, and also the import costs. Okay, so for the economies will be great. So the Brits and also the Greencore, they have facing the same factors, which is the inflations and also the operating cost risings. And for this one, the Brits have faced have more affected by the customer spending are going down. And this is because that the customer purchasing powers are down. And also for the Greencore, they have might a little bit different because it also have like limited ability for the supermarket customers. So for the next slide, will be socials. So for the socials, they have the the grids have facing the increasing the demand of the healthier and also the vegan products. And for the Greencore, they have also facing the growing demand for the convenient and ready to eat meals. And for the grids, okay, so for the technologicals, the grid and Greencore, they have a little bit different. And for the breeds, they have to improve their customer experience through the mobile apps, delivery service. And for the green core, they have the automations and manufacturing technology. And for this one, the green core, they have to improve the product service and also the product efficiencies. And next slide, please. So for the legal, the breeds is more the breeds and also the green core is facing also the same issue, which is the street food reservations and also the for the Brits they might be facing the labelings and also the employment law. And for the Greek code they might have a little bit different, which is the quality control, and also they have to fulfill the requirement for that. And for the environment, the Brits is also have to maintain the sustainability, and for that they have to reduce the packaging waste and also the carbon emissions. And for the green core, they also have to reduce the food waste and also they have to promote the eco-friendly packaging. So that's all for me. I'll pass to my group members.
So next, I will talk about the financial analysis findings. So in the ratio, it's separated into 5 categories, which means liquidity, efficiency, profitable, and varying the market value. So for liquidity, both company is remain with because they have felt the ratio from 2022 to 2024, and the green core is also stay around 0.57. So which means their performance are not very well. And next is efficiency. So both company performs very better because they are the food industry. Their inventory turnover is much higher compared to other industry. And the receivable collect for both companies is risk perform better because it can collect the debts around 11 to 12 days. But for Greencore, they need around 15 days to get back the debts. And next is the profitable. So both company is making a profit. For the Greeks is around 60% and for Greencore is around 30% plus. So their margin is almost same, is around 10% because their industry is almost same. So they will have the big gaps for the income. So their return ROE is both companies is have a lot of changes. So one is 27%, one is 10.3%. But compared to two companies, Greek is more profitable. And next is gearing. So the both companies is the debt to equity for Greek is below 1, which means their interest coverage is remain more stronger. And for Greencore is the debt to equity is improved to 0.56, and the interest coverage lower at around 3 to 4. So the debt to equity, which means below 0.5 is more better. And the market values EPS for both companies is increased from 2002 to 2024. So but then Bricks is perform more better. They can generate more returns for their shareholder. That's all is my part. Next.
All right, so I'm going to talk about the common size. So when you look at the cost of sales for these two companies, right, Greeks have around 38% of its revenue for the cost of sales. And when it comes to Greencore, it's the cost of sales is around 70%, so it means that the gross profit is around 23%. Why is it lower compared to Greeks? It's because that Greeks actually have control over its manufacturing and its supply chain. However, for Greencore, it's a manufacturer with a higher input costs. So when it comes to operating costs, right, For Greeks, their distribution and selling cost is around 47% of its revenue. However, it's way lower for Greencore. It's because Greencore is actually a B2B business model. So that's why it's directly dealing with supermarkets instead of millions of consumers. So let's talk about the non-current asset. The non-current asset, there's an increase in 71 to 81% of their assets. And there's a decrease for Greencore because it's just asset reduction. Yeah. Why it's increasing for Greeks is because they're actually doing expansion, basically opening more stores around. So when it comes to their current asset, right, both of them have dropped quite a bit. And for current liability, both increased. However, it's very high for Greencore, around 42.2% of its total asset. Okay. Now we're going to look at the percentage change. As you can see, Greeks have a very consistent revenue growth with 19.6% during 2023 and 11.3% during 2024. For Greencore, it's around 10% in 2023. However, there's a decline in revenue during 2024 with a negative 5.6%. However, when it comes to profit for the year, right, Greeks actually only make 7.6% during 2024, and Greencore actually make more with 28.9%. Why is that? It's because actually Greencore have better cost control and margin, so that they actually make more profits from having lesser sales. So when we look at their total asset, it's 16.8% for Greeks, and negative 7.2% for Greencore. As you can see, our total asset is increased because they actually buy more equipment for the new expansion for the new stores. So when we look at the cash and cash equivalents, both of them actually have huge decrease when it comes to cash. Why is that? As you know, they're buying more equipment, all the stuff. And for Greencore, they actually lost 50.8% of this cash because they're actually paying their debts. So when it comes to total liability, right, there's increase for Greeks because due to expansion related obligation. And for Greencore, it decreased, as you know, they're paying off their debts. That's why their total liability has increased. So overall, right, the Greeks actually have strong growth but cash pressure. But when it comes to Greencore, they have better profit control but weaker liquidity. So I'm gonna pass to Tiffany. Yeah.
Okay. I'm so sorry for the quick, sorry. So we find so after all the analysis and all those like percentage change analysis, common size analysis, pastor analysis, ratio analysis, and all those, we final recommend we final recommend Greek. I'm so sorry, it's not correct. Okay. So although Greencore it is Greencore, Greencore is improving and remains a strong company in the convenience food industry. Greek appears to be more financially stable, and then it is more profitable, and then they can attract more to investors. So Green is a better investment option. They have stronger profitability, EPS, stronger EPS, and then stronger interest coverage and a better brand value. And they have a very long-term growth potential as well. So that's all for us. We will recommend Green, and then thank you. Any questions?
Okay. You have mentioned that non-current asset of Greek has increased due to the expansion, but there was a drop in Greencore Group's non-current asset. You explain why that happened.
For you mean for the current asset, why is it drop? It's because drop in cash.
Non-current asset.
Oh, non-current asset. Oh, non-current asset. There's
try to answer.
Yeah.
Is it other members also can help?
Yeah, all of you all can.
Didn't really explain why just that the statistics just
Logically.
increase, yeah, logically.
Logically, why non-current asset drops?
Mm,
No expansion and have
higher caps. Is it?
higher depreciation.
Depreciation.
Okay.
Okay.
Next question. If you think food safety is in your legal requirement, then why there is also a point factor in political factor?
Miss, can you repeat again?
Okay, so there's food safety in legal, right?
Yes.
You go back to politics.
Okay.
There is also food safety. Can
Yeah.
you just briefly tell me what's the
Okay,
difference?
so now is that because the UK situation, so they have might be the government. I think it's from the government. Government have a big like strict for the food safety regulations, so that they have to so the legal have to follow the what the government says. So that is the connections part lah, I think.
Okay, thank you. That's all.